So there's something called the disposition effect. It's an economic term which suggests that people hate to sell their investments, specifically stock market investments like buying shares and stuff. People hate to sell their stock market investments when the price is lower than what they paid for. So for example, if I bought 100 shares of company A and I waited a year and the price is so that would be and the price was £1 per share, that would be £100 of company A. And a year later, the share price went to 74p per share. So now the total value is £74. So I've lost £26 if I sell. The disposition effect is basically people are really sad and scared that they generally feel negative emotions to having to sell those shares, and they're really hoping that a miracle will happen that will push the share price back up. So there's also the opposite, which is basically people sell their shares to when the value increases above what they paid for it. People sell at the wrong time because afterwards sometimes the price tends to keep going up. So in this video I just wanted to describe the disposition effect. It's an economic term. It's an economic term that basically describes people's negative emotions towards selling the share for lower than what they paid for it. And people tend to get attached to the stock because they're hoping that people don't want to lose what they invested. They're hoping that a miracle will happen to push the share price back up to at least allow them to break even. But that's what the disposition effect is.